Crypto leverage trading, is it the financial equivalent of strapping a rocket to a bicycle? Or is it actually a precision instrument that disciplined traders have been quietly profiting from for years? Buckle up, because the answer is going to make some of you uncomfortable and others of you dangerously overconfident. And both reactions are exactly the problem. The story starts simply enough. Exchanges like Binance and Bybit started offering retail traders access to 10, 50, even 100 times leverage on crypto positions. Essentially, letting someone with $1,000 control $100,000 worth of Bitcoin. That sounds incredible until you realize the market only needs to move 1% against you to wipe out your entire position, and crypto moves 1% while you're still reading this sentence. Back in 2020 and 2021, leverage trading was the golden ticket narrative. Influencers were posting screenshots of turning $500 into $50,000 overnight, and the comment sections looked like a lottery winner's retirement party. Now those same accounts are quiet, the screenshots are gone, and somewhere out there, a guy named Tyler is still explaining to his girlfriend why their vacation fund evaporated in 4 hours on a Tuesday. The psychological damage of leverage trading is underappreciated, and genuinely serious studies show that over 80% of retail leverage traders lose money, and yet the product keeps growing because the 10 to 20% of winners are extremely loud. It's the same mechanism as a casino floor. You don't hear about the losses, you hear the bells, and your brain does the rest of the statistical manipulation for free. But here's where we have to be honest with ourselves. Leverage itself is not the villain. It's a neutral tool that amplifies whatever you bring to the table. And if what you bring is discipline, a clear thesis, and ironclad risk management, leverage can sharpen your returns in ways cash trading simply cannot. The problem is that the market doesn't care what you bring to the table. It will flip it over and charge you for the cleanup. Historically, we've seen this cycle repeat across every speculative asset class, from margin trading, railroad stocks in the 1880s, to the dot-com era options frenzy, to the crypto blowups of 2018 and 2022. The pattern is identical. Access democratizes, participation explodes, losses concentrate, and regulation eventually shows up wearing a suit and a disappointed expression. Each cycle feels new because the asset is new, but the human behavior driving it is embarrassingly ancient. Let's address the misconception that leverage trading is only for professionals or only for degenerates. The truth is, it occupies a middle space where it's completely appropriate for a small, defined portion of a portfolio when paired with hard stop losses, position sizing rules, and zero emotional attachment to the outcome. The mistake isn't using leverage. The mistake is using leverage without a written plan, which is basically the equivalent of going into surgery and just winging it. Here's the practical framework that actually works. Never risk more than 1 to 2% of your total portfolio on a single leverage trade. Always set your stop loss before you enter the position, not after. And treat every leverage trade as a defined risk event with a known maximum loss, not a lottery ticket with a dream upside. That's not glamorous advice, but glamorous advice is what got Tyler into his current situation with his girlfriend. The broader macroeconomic context matters here too. Leverage trading volume spikes during bull markets when people feel invincible, and it creates a feedback loop where leverage longs fuel price increases that attract more leverage longs until the whole structure collapses under its own weight like a financial Jenga tower. Understanding that you are operating inside a system that is self-reinforcing on the way up and catastrophically self-reinforcing on the way down is the single most important macro insight a leverage trader can carry. Community wisdom from experienced traders tends to converge on one uncomfortable truth. The best leverage traders are almost boring in their consistency, running the same setups, same risk parameters, same position sizes week after week, ignoring the noise that makes everyone else twitch. They're not the ones posting moonshot screenshots. They're the ones quietly compounding small, managed gains while the rest of the market chases headlines. The irony at the heart of this whole conversation is that the traders who approach leverage with the most fear and respect are exactly the ones most likely to use it successfully, while the traders who approach it with confidence and excitement are statistically the ones funding everyone else's gains. The market has a dark sense of humor, and leverage is its favorite punchline. So where does this leave us practically? The answer is that leverage trading belongs in the toolkit of a mature, experienced trader who has already proven they can manage risk on unleveraged positions. It is not a starting point. It is not a solution to a small account. And it is absolutely not a substitute for having a real investment thesis. If you can't explain in 2 sentences exactly why you're entering a trade and exactly where you're wrong, you have no business adding a leverage multiplier to that confusion. Philosophically, the traders who survive and thrive long-term are the ones who fall in love with the process, the research, the risk management, the journaling, the review, rather than falling in love with being right or getting rich quickly. Because the market will always eventually humiliate anyone who needs it to validate their ego. Discipline, sizing, and consistency are the only edges that compound over time. Everything else is just entertainment with financial consequences. Whether crypto leverage trading ends up being a chapter in your success story or your most expensive lesson depends entirely on which version of yourself shows up to the trade, the disciplined strategist or the excited gambler. And only you can control that. We're completely comfortable with either outcome for our own positions because we've done the preparation, set the parameters, and accepted the risk before touching the keyboard. If you're ready to build real financial foundations, whether that's through real estate investing, home contracting projects, or finding the right lenders to grow your portfolio, check out our links in the description below, and let's get you started the right way.